I think a lot of people will do things by trial and error, and it's a painfully slow process, and also can end up being way more expensive. I would argue it is more expensive to do it that way. But if there's something that you want to do, there's somebody that already knows how to do it. They've already done it.
Yeah.
And you just got to pay them, and they'll just show you, right? Now, maybe they're not good. Maybe they are. I've had some that have been really good. But I think, if I'm going to go try something and I'm going to go by trial and error, I think I run the risk of losing way more money than what I would have paid an expert to just show me how to do it.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
So my name is Christian Duncan. I own a mortgage company, Epic Home Mortgage, and I'm a real estate investor. And I do some private money lending for a lot of people that do fix and flips, and do some development stuff and just a bunch of different things.
Okay.
Yeah.
What have you done throughout your career? What experiences brought you to this point?
To this point, man. That's a good question.
I mean, that's a lot to unpack. But
it is.
What are the highlights? What are the main, what are the main points along your journey?
Yeah, I think, I started out as a temp employee, dropped out of college. So I'm a college dropout. Yes. And I don't know, just determination, just completely determined to figure out some way to get out of living paycheck to paycheck. I grew up in a family that lived paycheck to paycheck. I saw the struggle, and I was like, that is not the way that I want to live. I just don't want to be that. So I don't know what I got to do, but I'm going to figure this out. So in my early 20s, like every book I could get my hand on, just, Rich Dad Poor Dad was actually the first one, Millionaire Next Door. Like I was just going after book after book after book, trying to learn, because I couldn't learn from my family. They're great, love them, but they couldn't teach me anything about the money side of things.
Can't teach what you don't know.
Yeah. They didn't know, right? They just didn't know. They were hard workers, right? Yeah. All of them, absolutely hard workers, but just didn't know exactly how to teach getting out of that. So read as many books as I can, found some cool mentors that helped me, and then just, learned and got a little bit better each day. And then I went through the same thing in 2007, 2008, lost everything, right? So before that, like I was in my mid 20s, I thought money grew on trees. I had, quite a bit there, and I was living like a rock star for a minute. It was fun, but then, 2007, 2008 came, and suddenly I was like, hey, Mom, can I borrow a little bit of money?
Yeah.
And I had to borrow some money. I had to borrow $5,000 from them for 1 month. And it was rough, but you know what? That experience was just a great one where I learned a lot. That's when I really learned how to be disciplined with money. And I learned, like, it doesn't matter how much you have. If you make some stupid choices with it, you can lose it pretty quickly. And I did that. I made some really stupid choices. I trusted people with some investments. I didn't know what I was doing. Kind of like what we were talking about earlier. I just kind of went into it, and then learned the hard way, and then started over and learned, okay, wait a minute, that didn't work. So what do I need to do? And that's when I learned, like, I got to put away a bunch, So from that point forward, I started saving 50% of my income and learning to live on the rest.
That's a big number for most people.
It was rough, man. And it, sometimes I felt like I was broke, but then I'd look at the account and be like, oh, okay, I'm not broke. I'm good. And so I've just continued living that way for the most part,
Mm-hmm.
and it was amazing how that account grew. And, it was just, I don't know, it was awesome. So I don't have to worry about those types of things anymore. It gave me kind of more of a simple lifestyle. I found things to do that I love that were absolute blast, that didn't cost much, right? Hiking, mountain biking. I mean, all of this stuff that I just absolutely love that doesn't have a huge cost to it. And just gave me a different, freedom. Like if I don't want to do something, I don't have to do it. I don't have to go and take a job because I have no choice and I got to pay the bills. No, I don't have to. If I want to take a lot of time off, I can. It doesn't matter.
Yeah.
Yeah.
I mean, without being too intrusive, or, you don't have to share anything you don't want to. When you made that switch of living 50%, would you say that your income at that time was, like low income, average income, high income earner? I think just to give context, I think it's easy for somebody to say, well, if you were saving 50% of your income, but you were making $1 million a year, right? Like you're still living a pretty sweet life on 50% of your income.
Yeah.
if you were making 40 grand a year and you figured out how to live on half, right? People would say, oh, that's a bit different. So obviously you don't have to share, too much detail, but just a little bit of context. Like, what were you doing at that time for a career job? And, would you describe that as, kind of low, average or above average income?
Yeah, I would say at that time it was probably above average, probably about 80 to 100 K a year. Now this was back in like 2011, 2012 or so.
Okay.
80 to 100 K a year, which, I mean, what is that? I don't know what that is now, a little bit more. So
yeah.
It was still, I mean, when you factor in taxes and all that, it definitely felt a little tight.
Yeah.
Right. I was maxing out the 401k. That's when the first year I did it. I had a financial advisor that was life-changing for me. Like I'm sure you are with many.
Yeah.
That just is like, hey, it's December. Let's max out this 401k. And I was like, what do you mean?
Yeah.
I didn't understand the tax benefits and all that of it. And so that was kind of the start of, I did that. And then I was like, I did that and I was okay. I'm still fine. Like I don't, I was able to just live on whatever else was left over. And then I thought about it and I was like, wait a minute, 07, 08, 09, when those years were really tough, I got by just fine when I was losing everything and income was really low. So that means I can probably get by just fine with living on a little bit, but I'm still making it and I can just put it away into something because I don't ever want to go through that again. Yeah. That was rough. I know a lot of people really had a hard time during that and, many lost houses. I mean, just a lot of it. And it was rough. And I think it was life-changing for a lot of people and like didn't want to go through that again. That was really the main part of it. And I was like, if I have enough put away, then I can weather the storm and I'll be fine. Yeah. And that's really what it came down to.
What do you think was the biggest mistake that you made that caused the hardship or the heartache in 07, 08 timeframe?
Yeah, two things. One was putting everything I had out there into investments that I didn't really know. That was it. That was the biggest thing. Trusting anybody else that gave me advice. Even though they had a little bit more than me, I didn't realize that they were still trying to figure it out. I just thought they knew what they were doing. Yeah. And so they meant well, like they had good intentions, but they weren't prepared for a storm to happen. Right now I know that no matter how good things are, there's always a tough time that comes ahead. The other was overspending, which I think, when I first started making decent income, that's when, hey, let's go to a nice restaurant. Let's go travel. Let's go fly somewhere. Let's go do whatever. Let's buy a gift. Let's do this is stuff that I didn't experience as a kid. And so it was like, after you start doing that, you go to a really cool restaurant. You're like, wow, that was amazing. Like, let's go do that again. And you don't realize those little things just kind of add up, over time. And you're like, whoa. Right. And so it was those two things that really contributed to it. And so once that market turned and every dollar I had was in real estate, and then it was like, all of a sudden I'm negative.
Yeah. Owe people money.
Yeah.
You can go like people I think that's one of the things people forget about, like, especially with real estate investments is, a common misconception I hear all the time is people will say, well, I'm going to invest in real estate because it's the safest investment. And what's funny to me when people say that is, academically, it's actually considered one of the riskiest investments. Right. And the reason why is because the amount of leverage and the nature of it, that it's kind of an all or nothing, right? Like real estate turns out pretty good or you lose it all, right? And so that risk profile is what makes it risky. So people say it's safe because it goes up over time. I think really most assets will go up over time. It's just that they don't have a way to check it in the meantime and panic sell like they do with a brokerage account or something, right? But yeah, if you go upside down and you foreclose on a property, like you can still end up owing even after you have had all of your losses. Right. So there's some risk there that is very uncomfortable and very unfun.
For sure.
No one, like you never want somebody to deal with that.
No, I think And I think I learned a good lesson from that with real estate that, it can be risky, but it can also be safe if you know what you're doing. Like I knew a lot of people that had investment properties and lost them all to foreclosure.
Yeah.
And really what it came down to is where they were from a monthly payment standpoint.
Yeah.
Right. So a lot of people had these loans, they were called 228. So you had it fixed for 2 years and then they would adjust. I had a couple of those as well. And when it adjusted, it was really rough. So like I had, there's one particular property that I'll talk about that I bought at the like extreme height of the market. Like within 2 weeks of what's considered the height of the market, I bought it, overpaid for it, right? But it was a property that had a mother-in-law apartment. I guess we call those casitas out here, but it had a mother-in-law apartment, and I was able to cash flow on that property. So for that one, I was planning on selling it in 6 months and making money on it. Well, in 6 months, that's when the market had dropped and like you couldn't do anything with it. So I was able to hang on to that one, but it's only because I didn't have any payment that I had to make on it. I was cash flowing about $1,000 a month on it. And so that property ended up making about $180,000 on it, but it took a decade.
Yeah.
And so the others that I saw, the other people that I saw that lost 10 houses or so, right? They were playing the appreciation game and forgetting about just kind of the monthly cash flow issue, right? So they were thinking, hey, I'm negative on this property $500 a month, and if I've got a few of them, I'm negative $4, $5, $6 a month, and that's fine because over the course of time, these things are going to go up. But the problem is when you start running out of cash because the whole market's dropping and you've got to come up with that, then you're forced to sell. If you're not forced to sell and you're in a good spot and you can hang on to it, you can ride the storm there, and you get to choose when you sell it, then you'll probably be fine. But if you get into a position where you run cash poor and then you have to sell it, then you're screwed, right? Now, luckily on that property, I was in a good position as far as cash flow, right? Because I was actually cash poor at that point in time.
Yeah.
So that one worked out. And I had a couple others that worked out and I resold them later and they did really well. But yeah, so it was a good learning experience. So,
well, I think what I'm hearing is that real estate, you have the opportunity to underwrite your own stuff a little bit more and have that control factor. And that's what a lot of people, real estate investors in particular, like is that control factor. And so that's where your risk management comes in is underwriting a deal or a property that is within the scope of the appropriate amount of risk for you and your financial planning. That's like similar to the Warren Buffett theory, right? Where his risk management tool, like he is not somebody, Berkshire is not going to go and buy options contracts to manage or hedge their risk, right? That's just not how they do it. They look at valuation that is their risk management, right? So they buy stuff that is cheap, that has, good moats, that's solvent businesses, and then they hold it for a long amount of time. And what's interesting, the other thing that you were talking about is you had this property and then you were able to hold it for 10 plus years. Mm-hmm. And so then the appreciation did work out and it was a positive investment return over that time. Yeah. Had you sold along the way, had you panicked and said, well, everything's going down, I better get rid of this before it really goes down, you would have locked in the loss.
Big loss.
And so sometimes I always have this parallel I'm drawing. I work with a ton of real estate investors as clients that they kind of do the real estate and I help manage the liquidity and, do all the planning around that. But like when people say like, well, day traders, it's a hard game to be a day trader. Very hard. It's hard to be a flipper. Flippers are the day traders of real estate.
Sure.
Right. You don't have a lot of margin of error and you're trying to get the timing done. Right. So like had the market stayed favorable for 6 months, you would have exited that property, had a profit, locked it in. Right. That's a trade. To me, that sounds just like a trade. Right. But what you quickly turned into was, okay, now my risk management is that it's cash flowing. So instead of exiting this trade like I anticipated, I'm just going to hold it.
Yeah.
And you had the ability to do that because you underwrote the deal a certain way. So I think that's where real estate, again, it can be less risk from the standpoint of you underwriting the deal correctly, right? But you have to know what you're doing. And then it's like you said, you can have all the equity in the world, but if you're cash poor, sometimes it's still going to come apart.
Well, and I think you just want to be careful not to put yourself in a spot where you have to panic sell.
Always.
That's it, because that's where you lose. It's the same thing with, if you have your money in the market, right? Like in 2020, what do we see, right? That thing just
Yeah.
dived, and everybody's like, oh my gosh, like it's going to, and everybody who pulled their money out,
If you hang in.
everybody pulled their money out lost, and those who stayed in, it came back and went up, 100% or something like
Yeah.
that in 18 months or something like that, right?
Yeah. In the academic circles, if you will, of like certified financial planners and stuff, they'll always talk about like, yeah, the best return you'll ever have over time, with any kind of reasonable assumption, right? Obviously, so barring getting like lucky picking, I bought Tesla at an IPO or something, right? Like barring getting lucky, is like if you just go out and buy, broad diversified index and you just hold it like for literally forever, like you just never sell. And the reason why people can't do that is because you have to have some kind of liquidity backup that you're not in the position that you have to sell when it's down. That's true. Like that's,
sure.
That's why there's balanced portfolios. That's why you buy some different assets. You have further diversification than just like, oh, I have an index fund that has hundreds of companies. You need some deeper level of diversification. The couple hundred companies keeps you from going to zero, right? Like as an example, and I'm talking about the index, the S&P 500 index, like just it fundamentally would be almost impossible for it to go to zero, right? Like it just, you can't, it can go down 10% and then you sell in an opportune time and you lose 10%.
Right.
But like that index is more than likely going up over time. And it's just what will make somebody a successful investor is, and I'm not always the biggest fan of this. Like I think it gets misused, but it's not timing the market, but time in the market. And the longer that you can stay in the market and just not have that panic sell or be in a position where you have to sell, that's where the magic sort of happens as an investor.
The way I look at it for that is there has never been a time where it hasn't come back. It's always come back. Well, sometimes it takes longer than others, but it's always come back. But yeah, it's when you panic sell.
It's like, well,
that's when you have a problem.
If you're in single issues, right? Like there's the idiosyncratic risk that can come with like a company can go to zero.
Yeah.
Right.
Yeah, an individual for sure.
Like, I know people that lost it all in Enron. Right? My grandfather was one of them. He owned some Enron. Luckily, I mean, it wasn't a big portion, but I know that he owned some Enron when that whole thing went down, it goes to zero. He was somebody that had the risk capacity to take on that sort of risk, and have it not change his life in any way, really. But, that's a risk you take with, single issues. If you're broadly diversified, the chances that when you buy a broad enough index, you're buying kind of, I equate it more to like buying the economy, right? If you buy, again, as an example, like the S&P 500 index, it really sort of tracks the U.S. economy. Economists their eyes are going to pop out of their head at that statement. I'm not saying it like, I'm not saying the charts align with the economy, you know what I'm just saying? But like if the U.S. economy grows over time, which I tend to believe it sort of has to, right? And when it doesn't, we're all in a bigger issue than what our investments are worth anyways. So like if the economy is growing, that means the companies that are participating in the economy are likely growing or producing revenues or cash flow, paying dividends or reinvesting in themselves and producing more revenues, being more productive, then that's going to grow. So even if it drops for a period of time, it's a temporary, repricing. It marches back. Sometimes some of the things that I think about is like if you scroll out on a chart and, it's easy to scroll out on a chart and just look at like the line, right? Like it just goes lower.
You're talking about like
lower left, upper right. Yeah, like
a chart over time of
chart over time and just be like, oh yeah, well everyone knows it goes up over time. But sometimes if you look at like an index level, right? So today the S&P 500 is like about 5,800, right? And you'd be like, okay, well if I was going to buy stocks today and the level of the index is 5,800, I'm like, okay, it seems a little, rich. Man, this seems like, and then you're like, wait, a couple of years I could have bought it at 2,800. What? You're like, okay, hold on. So even if it goes down a little bit, like we're way past what it was just even a couple of years, a couple of years ago. It's, you got to stay the course, right? So just a different way I've thought of things sometimes. Like I always look for different ways when market volatility is going on. Like how can I look at this different? Because
are you saying like people might be hesitant to get in because they look like the price is too high, like it can't stay that high,
or like
so I'm nervous about getting in.
Or if it's like going down a little bit right now, like it's going down to 5,600 or it's going down to 5,500 or whatever. It's like, okay, well, dude, a couple of years ago it was at like 2,800.
Yeah.
It's like, so.
And there were probably people then saying it's way too high.
Exactly.
It's inflated, don't buy.
Yeah.
Right.
That's totally my point, right? Is like, that's how people were feeling when it was 2,800 a couple years ago. So you have to stay the course right now.
Right.
Right. You got to stay involved. You got to not panic, and then realize that in another 10 years, you're probably going to be looking back going like, can you imagine? Can you believe I bought it at 5,800 only? You know what I mean? Like, it's just not to say there isn't going to be pain or emotion in the meantime, but that's how investing sort of works. If there's no volatility, if there's no risk, I mean, that's the price we pay for gains, right?
For sure.
100%. We pay with emotionally weathering it is the price we pay to kind of have those returns over time.
And that's why sometimes it's better to have somebody else managing it.
Oh yeah.
Because the emotion.
Yeah.
The emotion part's hard. That's where you can panic a little bit.
Yeah.
It was like 2020, after just after COVID, right? I saw the liquid part of my portfolio drop by hundreds of thousands like that. And I was like, but luckily I'm not managing it. I've got somebody else managing it. And so he was my therapist for that day.
Yeah.
Right. And
I'm calling I know that.
You probably do, right? Yeah. Everybody's calling you like, what's going on?
I usually proactively call people.
Do you?
I kind of know who's going to have, a little bit of concern. I know who's watching their accounts more closely, and I tend to just proactively call them.
And you need that sometimes, because when you lose that much, right? And you're like, it took me forever to get that. And then all of a sudden it's gone in like a couple of days. And you need somebody there to be like, hey, it's okay. Like these types of things happen. Yeah. But if we look at in the past and history of what's happened, we can go back however many years, it's done this. There's always been, it's those that are panicking, that are selling, and they cause it to drop. But let's just keep with our plan, because over time it's going to come back up, right?
And sometimes it's just forced selling, right? And that's when you get the most extreme market moves, is the forced selling, the margin calls, right? It will just go down more and more and fast. Mm-hmm. And the faster it goes, it's a negative feedback loop until it stops, right? I mean, we saw that at one point this year, right? In the beginning of August, when the yen carry trade was kind of coming unwound a little bit. But market catches a bit at some point. Like, it cannot, again, going back to like, it technically can go to zero, but for the broad US stock market to literally all the companies to go out of business at once we got bigger problems to deal with. Right?
I agree 100%.
Way bigger problems.
For sure.
Your retirement account doesn't matter if that happens anyways.
100%.
So one of the things that's I found interesting that I've really been able to get out of people is, I think they're at the most risk for this type of panic the closer they get to retirement. Mm-hmm. And the reason why is their accounts start to get bigger, and they start thinking in terms of how many years of income that is, right? So if you're coming into retirement and you're like, I'm going to retire in a couple of years, I'm somebody that has saved diligently. I have $1 million in my 401k. I make 150 grand a year, and you see your account drop by 15%. You're like, that's a whole year's worth of working.
Right.
Like, that's how you think, right? You're like, that is sense, a whole year's worth of working gone. You're like, well, it's not gone. It's gone if you make rash decisions right now. You know what I mean? But it when it comes to investing, right? Money comes, money goes, but you have to be able to frame it up and think about it a different way. And I think trying to break people out of that habit of, stop thinking about it, of like how long it would have taken you to work for that money, right? Because at this point, you're not working for that money. Your money's working for that money. So you got to disconnect it at this point. But it's tough. It's tough to coach people through that sometimes.
Well, and sometimes it's tricky because you can see, minute by minute what it's doing, right?
Oh, yeah.
And that can be a little stressful. It's like, there's other investments that I have no idea until we go and we have a liquidity event, right? We have no idea. So it's not stressful until at that point in time, we're ready to do something.
Yeah.
But like that, it's like you get a play by play anytime you want it.
Yeah. John Bogle, the guy that started Vanguard, that's why he was actually a fan of mutual funds, because mutual funds only strike NAV, most of them anyways, only strike NAV, which is the net asset value, or like the valuation of the fund, once a day at market close. And so, that's the one time in which you can trade. So if you trade a mutual fund and you put a trade in at, 10 o'clock in the morning, it trades at the market close. That's when it will actually liquidate out. And so any market movement that happens in the meantime, you're just getting, like, you're absorbing all that. You can't say, oh, it's 10 o'clock in the morning, you just punch me out now, the market's in a good place for the day. Like, nope, you get whatever end of day is. And that's how mutual funds work. He was a fan of that because if the market was like behaviorally, like it was down a lot, it like forced a cool off period almost for people, like,
that makes sense.
And like, okay, well, I'm not going to get out till the end of the day anyway, so maybe I'll pause. I'll come back right before the end of the day and put in my order. Or market's going crazy, everyone's talking about it, you check your account. well, you're not seeing the repricing happening because you're like, oh, well, my account's fine. Everyone's freaking out. My account's fine. Well, your account's not fine, so to speak. It's that you're not seeing that minute by minute price movement. You don't have the constant repricing like ETFs do. Now, that being said, I think ETFs are a far superior vehicle to hold your investments for most things, particularly around liquidity, transparency, and tax efficiency. But that's a whole different conversation for another day. But that's why I put John Bogle was a fan of the mutual funds. It would kind of
that makes sense.
Trap people a little bit, you know.
I like it. It takes a little bit of the emotion out of it.
Yeah.
For one, you can't watch the play by play, and if it's down at that moment, you're going to be a little hesitant because you're like, well, if I put in something to sell now and it just continues dropping, then I'm going to be.
Do I really want to sell, or should I wait? If it goes down far enough, should I wait? And you know, so it forces people to just think a little bit more. I'm still not a big fan of mutual funds. There's one specific situation, maybe two.
One or two.
But
okay.
Yeah. Well,
what do you think about? So, I have my kids in the S&P 500, right? I make them put away half of their money into a custodial account, right?
Okay.
What do you think about starting them young?
I think it's a very individualized decision parents should make for themselves, considering their own financial situation, the ability to their emotional capacity to help a kid, teach and learn through that experience. And then I think they should also take into consideration some of the control factors. And are they doing all the other things correct to equip their kids with the knowledge and the emotional capacity to handle that kind of those kind of resources when they come of age.
Okay.
So to give context to what I mean, and I don't know how much you're putting away or how much they're putting away, right? Like, I don't know, maybe they're putting away $6 a month, right? And at that point, what I'm about to say probably doesn't matter. And it's probably a great learning experience, right? Like you could make a lot of wrong choices. Your kids could make a lot of wrong choices. They're saving $6 a month. It's never going to be life-changing money, right? But the experience could be life-changing. So, I'm a fan of that idea.
Yeah.
If you start talking about like pretty serious money, and not serious, like, hundreds of thousands of dollars or something, but people in particular that like pay their kids and then, fund a Roth IRA or a custodial account using, like a UTMA account. The risk that they run is that even if they're only putting in, $6,000, $7,000 a year, they're starting this when a kid's maybe, 10. Well, just on cost basis alone, they're going to have, $70,000, $80,000, $90,000 plus you put in some gains. So you're talking about a kid that's going to be 18, have access to $100,000, $120,000, and you can't stop them from accessing it.
Mm-hmm.
Some kids will handle that just fine. Some kids may not know it exists, but then I beg the point, well, you just missed a big opportunity to coach them through all this and use this as a learning experience, right? So you want them to know it's there and available. Right. Is the kid going to be ready to, be handed the keys to the Ferrari, so to speak? Right? Because
no, that's a valid point for sure.
If they're not ready, that investment account you just help them build is probably going to turn into a Ferrari or a Corvette or a Mustang or, you know what I mean?
It's possible. The way I look at it, like you have kids?
Mm-hmm.
Okay. How old?
2 in a couple months.
2 in a couple months. Okay. So you're not through this part yet, but when they're 3 or 4 or whatever, they start to get in the back seat and they jump into the car seat on their own, right? And so you have to tell them, put your seatbelt on, 1,000 times, right? And then it's like you're a broken record, put your seatbelt on, put your seatbelt on. And all of a sudden you go to look back and tell them, put their seatbelt on, and they got it on and they're ready to go, right? It's the repetition of constantly hearing from you. Like, it's not the logic. Like, I'm not putting my seatbelt on to keep me safe. Like, I don't understand that. They're too little. Right. Yeah. It's the repetition of them doing it. Them doing that action all the time that it becomes more automated for them. So my goal with them, as far as their money, is any time that they get money, they have to put 50% of it away. Okay. So that includes Christmas, that includes birthday, that includes whatever, right? They have to put 50% of them away. Well, now we're getting to the point where I don't have to beg them for it. Hey, Dad, I've got this. I just got my birthday money and here you go. Here's the 50%. If they can just learn that, they'll be fine. And then every time when we get the statement, we go through it together. So when it goes in up, down, whatever it does, we talk about that. And so the hope is, and my kids are 12 and 14, but by the time they get of that age, we've had so many conversations about the market moving up and down, right? That they can start this life and maybe they'll have 50 grand.
Yeah.
And those first few years when you're 18, 19, to 21, those are tough years, and it's not going to get easier. It's going to get harder.
Yeah.
So if you're starting out at zero and you're trying to figure it out, it's going to be even that much more difficult. But if you started out with some sort of financial education, like, hey, I've got all this money and I was there for the whole part of it. I know how I got it. It wasn't like somebody just gave it to me.
It was like, and they saved it themselves.
They saved it themselves.
Yeah.
And I give them some for, whatever birthdays or whatever, but but the vast majority of it that's in there is all them.
Yeah.
And then as they become, 16 and they start working, we're going to have the same rule. Do they like it? No.
Yeah.
But they understand it when those statements come in and they're like, oh, okay. And it can, my hope is it's going to make it a little bit different for them. So when they're that age, 18, 19, 20, and they've got this money, right?
Yeah.
They can be a little more selective about the job they choose. They don't need to go work something where they just absolutely hate it, right? They can go and pick something that maybe pays a little bit less, but gives them the experience they want to get them where they want to be.
Yeah.
Right? If they start out and they're just they're broke and they need to have a job right now, they're going to take the first person that says, yes, I'll hire you. Right? And that's not freedom. I want them to have the freedom to choose, but they have to have that discipline along the way. And we're talking a decade of discipline for them to create it. It's not like it's an overnight thing. It's every time they get money, we're putting it in, we're opening the statements every month, we're looking at those. And it's just kind of getting ingrained in them that this is what happens. And they look around and they'll see the other family members who haven't done this and they're struggling and they're thinking, I have enough money to pay the mortgage and I'm 12.
Yeah.
You know what I mean? And then they see, okay, the way I got this was all those different, all that little bit that I put in.
It's the consistency.
And now it's starting to grow. We'll find out. It might not work.
I think out of anyone that's doing that, I think that's probably one of the better plans that I would say has a decent chance of success. And the reason why is you're not, you're trying to give them foundational habit coaching. You know what I mean? It's not about the investment returns. It's not about picking a stock. It's not about, you're not trying to like get it complex on the tax strategy. Just like, dude, you get $10, you
Simple.
put $5 in this account.
It's got to be simple.
It's simple. And so you're instilling a basic discipline around them. And then you're not like putting it away where they can't see it. You're helping. The thing that I like that you're doing is that you're having constant conversations with them when that statement comes in. I think that's probably a part that so many parents don't take the time to do, right? Is to say, okay, well, you've put away the money, markets go up, markets go down. Let's talk about what's going on. Cause like somebody's 12 and like, they're like, I got $30,000 in this account or something. It's like, and then they're down at 25 and up to 34. And that's twice as much as their friends make in a whole year. It's like, and they're doing nothing.
You know what's funny is how they understand the perception of value with it. How many Xboxes can I buy with this?
Yeah. There you go.
They don't understand the dollar amount. We would go through and we'd get the statement and we'd look at the dollar amount in there and they would go, well, how many? And it was actually at that time it was Wii's when they were
Nintendo Wii's.
Nintendo Wii's. They were like, okay, how many Wii's would that buy?
Mm-hmm.
And so that's a thing of value that they can figure out, okay, how many can I buy with that? And then it made sense to them.
Yeah, they want to put it into context. Yeah.
Yeah. It was so funny.
Yeah. Well, your kids sort of have the other thing too is I think your kids have it a little bit lucky nowadays with the investment vehicles that are available, with like broadly diversified, ETFs and funds that are available. My grandpa did something similar for my dad with the corn project, and he talked about it on an episode I filmed with him. But in essence, my grandpa made my dad and his siblings grow sweet corn on the family farm. So he taught him how to work, and then he made him run a roadside corn stand, keep a P&L, and then, showed them how to save their money in a savings account and stuff. And then the third year, he helped my dad open a brokerage account. My dad had to like pick stocks, because this was the 60s. Yeah. It may be early 70s. But, my dad's like picking stocks. My dad doubled his money. And when he was 16, he took some of his gains and bought a Camaro when he was 16 in high school, a 68 Camaro SS.
Awesome.
And
hopefully he still has it.
No.
Oh man.
No. In like true CPA personality, which he wasn't even CPA yet, there was a piece of Bondo on it. And he's like, it's just not perfect. I don't want, we'll just, So, he sold it. Yeah. Sold it, I think before his mission, helped pay for his mission. And, anyways, his big epiphany around investing was like, oh, wait, I have all the money I saved. Mm-hmm. It's in this like statement and I have a Camaro. It's like, that's cool. But yeah, I mean, you had to pick stocks back then. Now you just, right.
But those are amazing skills that your grandfather taught him. So if he has those skills, he can go out life like he's got a leg up on everybody, right? Yeah. I mean, life's more simple because he understands that stuff. A lot of people don't, and it makes life harder.
Yeah. Sometimes I wonder what stocks he picked. I don't think he even remembers. I've never asked him.
Maybe it was random.
But, well, if he was guided by my grandpa, I almost bet it was utility stocks.
Okay.
My grandpa was a big utility stocks guy.
Okay. So we have a long line of stock pickers here.
Oh, we're not stock pickers anymore. I'll tell you that much. Yeah. Nope. I don't try to pick stocks. I think that's a tough game. Yeah. Almost a losing proposition, in my opinion.
For sure.
Some people do it. Some people do it great. Some people do it and they get really lucky and it turns out great. And a lot of people do it and it just turns out really bad.
Yeah.
So I like making more calculated investments where I feel like I can quantify your risk return profile a little bit better and I can avoid that idiosyncratic risk.
Yeah.
I mean, but I was raised around risk management and anyways.
Those are good skills to have.
Yeah.
And it's nice. It's a little different now than what it was back then.
Yeah. Yeah. Well, it's yeah. So investing nowadays I think is like, it's easier from a skill set standpoint. It's more difficult from a behavioral standpoint.
Yeah.
Because when my dad was growing up, he had to like check the paper to see how the stocks are doing. You know what I mean? Like,
what if they had a typo?
Yeah. Well, I'm sure stuff happened,
right? He's like calling him sell.
Actually in the CMT
program. There's a typo.
In the CMT program. So I'm in the program working on a CMT, which is a chartered marketing technician. One of the things they teach is when you run data, you actually have to scrub that data because, especially if you're working with older data sets, because back in the day, like somebody would be on the trading floor basically of the stock exchange and they would just be yelling stuff out. And so somebody's just typing in the price all day. Like that's their job, is type in all the price. And all of a sudden they hit, like the decimal in the wrong spot. And so you have like this data coming in, this data stream, and then all of a sudden a huge spike, and then back down. It's like, well, if you're trying to run like a historical study or something like that, it can throw off all the forward-looking data sets now and your return assumptions. So you have to like scrub data and then be willing and prepared to like basically say like, okay, I'm pretty sure that was just human error and adjust the data.
Mm-hmm.
I didn't realize that was like a thing prior.
I didn't think about that either. But
growing up in a digital world, I just figured it was always right.
If there's humans doing it, like there's going to be some mistakes there, right? The typos and the decimal point. So, it matters.
You got to be careful with old data. Anyways, okay. So you now work in mortgage.
I have since 2001.
Okay.
It's been a while.
Currently still in mortgage.
Currently still am, yeah.
You spend a lot of your time educating people on your YouTube channel.
Yes. Hopefully more going forward.
Yeah. So, if I remember right, the first time we met was we actually both spoke at a men's event.
Oh yeah.
Right.
Mm-hmm.
That was, yep. And we started talking, and this was back in, was it 2021 still or 2022?
I think so. Somewhere around there. Yeah.
There was this big thing going on about paying. They call it velocity banking.
Yes.
And for those that have not yet had the displeasure of hearing what velocity banking is, it's a concept where you take money off of a line of credit, like a home equity line of credit, and apply it towards your fixed mortgage. And then, rather than making extra mortgage payments on your fixed mortgage, you make your normal mortgage payment plus pay off your home equity line of credit that you've now accrued. You pay that down, and then you try to do this whole scenario where you get paid, you put all your money in your HELOC, then take it out throughout the month and pay the home down, and
You
pay
use
the
your
HELOC
HELOC
off.
like
It's-
your bank account.
Yeah.
Yeah.
And I remember you had asked me about it, and I went, I don't think the math works on that. And somebody else was telling me about it, so I went and built a spreadsheet. I built the Excel model because I'm an absolute dork, and was like, no, I'm pretty sure the math doesn't work on this. And I played with all these scenarios, where I was like, okay, well, what if the interest rate's this on the HELOC and this on the loan, and what if you do this much versus that much, and basically there's really no controllable variable in which this really starts to make any kind of sense mathematically. What I was finding is that if you get the right interest rate loan arbitrage, you might save yourself like $200 or $300 over 20 years. You'll waste it in moving your money around on all this stuff.
It's incredibly complex.
And if you accidentally accrue interest on your line of credit before you get it paid into the bank, like, because it maybe takes like, you pull money off your HELOC and it starts accruing interest immediately, but it takes 3 days for the bank to cash the check against your mortgage. So you actually accrue net interest across those 3 days on both. So I think like that one thing could eat up your potential savings anyways, like in just a couple, running that scenario. So within a margin of error, this doesn't work.
No, it was interesting. So I had a guy who sold this, like he had a real estate education company, and he sold this as a package, and it was like $2,000 to sell you this thing on how to do this, right? So he came to me saying, hey, I've got this really cool product for all your clients. I want to show you what it is. Let's go to lunch. And I'm like, okay, cool, let's go. So we go and we check it out, and he's got his spreadsheet.
Yeah.
Right. So he's asking me like, how much did you make? All of his stuff, like what's your mortgage, all of that. And so he runs these numbers, and it's funny because, the pitch is like you're using your home equity line of credit as your bank account. So for those who don't know, right, you put all of your money into that home equity line of credit. So you pay it down, and then you pay your bills out of there, right? And then you leave all the money in there. And because you have that lower balance, it's going to save you everything and pay off your home in 5 to 7 years. So he goes through the spreadsheet, and then he determines, like, based on my income and what my debts are and all of that, I can pay my house off in 14 months. So this guy just steps up and he's like, do you see how it works? You see how good it works? And I'm like, yeah, if I put every single bit of my disposable income into the mortgage to pay it off, you're right. I will pay it off that fast.
Yeah.
But that home equity line of credit has a higher interest rate than my primary mortgage. So it doesn't make sense to do it that way. I'll just save my $2,000 and then save the extra interest on that HELOC and then do it this way. No, it doesn't work that way. Show me how. I'm going to get another guy to put that together, and I'm going to get him to show you. And I promise it doesn't work that way. It's better if you put it this way. So I went back and I'm like, I'm going to test this. And I did the same thing as you, as created a Excel sheet. I'm not quite the freak in the sheets like you are on that, but I went through and put together this Excel spreadsheet, and I ran a bunch of different scenarios, and every way it took longer to pay it off than if I just put it towards the mortgage. So I sent it over to him. I don't think I ever heard anything back. And then I was like, I started seeing all these ads on Facebook, pay your house off in 5 to 7 years by using this particular method. And I was like, that's the same one. It's the same one that he was teaching me, and they're charging money for it too. And I'm like, all right, I got to at least let people know about this, or at least the people that follow me. So I created a video about it. And it was interesting. I posted the video, and then first hate comment came, right? And I was like, oh no, what did I just do? Because I was questioning myself for a minute. I was like, I better double check that math. Did I really get that right? No, I got it right. Okay. So second hate comment came in, and there was like 10 hate comments came. And then it just kept growing, right? Just more of them. But then it kept getting more views. But then I was looking at the thumbs up, and I was like, okay. And then I'd have some people private message me like, oh, thanks so much for posting that. It helped. And so then I started liking haters on YouTube because it just makes things spread more.
Sure.
And then I realized that, these are the people that are selling it, and I'm a threat to them. And so one of them made a hater video about me on it, which was awesome, I thought. And then there was actually another one who was a really respectful guy, said, hey, can we just meet about this, and let's film it and post it on YouTube? And I'm like, cool. And I thought he was really going to come at me and just try to come after, my either, mortgage experience or whatever. And, I don't know what I'm talking about, but it was actually a really respectful conversation. He was a really nice guy. But what I learned was like, this was his circle and he hadn't seen anything outside of that circle. And so he fully believed that it worked the way that he was told. And so we kind of went through it, and I don't know, you could tell based on just the way he was explaining things, right? He would say, well, let's talk about, this 30-year loan, it's amortized interest. And I said, say that again. He goes, this 30-year loan, it's amortized interest, whereas this HELOC is simple. I said, there's no such thing as amortized interest. Amortizing is a way of calculating what your minimum payment is in order to pay something off.
In a set amount of time. In
a set amount of time, right. There's no such thing as, there is. Google it. Pull it up, right? Simple, compound. That's it. Those are the only two that there are, right? And so he had trouble with that because you could tell all of his mentors, everybody that was teaching him and teaching him on how to sell courses, they're all pushing this amortized interest thing. And they're like, it's so front loaded. So he pulls up and he does these two examples. And he goes, let's take this $300,000 loan and we're going to say on a fixed rate mortgage, it's 3% interest, and on a HELOC, it's 8%. So he has me calculate the payment. And then he goes, okay, how much of that is principal and how much is interest? And I go, whatever. Let's say the payment's $2,000. And I go, well, $1,900 of it's interest, $100 is principal. He's like, see, it's front loaded. He goes, now let's look at the HELOC. So what's the HELOC payment, right? And he goes, well, we're going to put in $5,000 of our income towards this, right? So only half of it's interest. I go, well, hold on. We got to compare apples to apples here. How much of that, if we move it from the HELOC, right, instead of the $2,000, what's the minimum payment on the HELOC? He puts his calculator out. It's $2,300. I go, okay, so it's $300 higher. So if you make the minimum payment on the mortgage of $2,000, how much goes to interest? $1,900. And I know you said that's front loaded, right? And if we look at the HELOC and you make that minimum payment of $2,300, how much goes to interest? 100%. Oh, that's front loaded as well, isn't it?
Yeah.
And then it was like, there was this pause for a minute, right? Like, and you could see like all of his mentors told him these things. And I think he had good intentions. I mean, I don't know. But it was like, it could clearly see that it just didn't make sense. It didn't work.
Yeah.
Right. They're trying to compare a fixed amortized payment to another payment if you deposit your entire paycheck into there. You can't look at it that way. It's like, what's the interest on this one? What's the interest on this one?
Yeah.
It's simple. And they're simple interest.
Yeah.
It was interesting.
I think it's something that people want to believe works because
somehow
it's like, what is the most painful thing right behind paying taxes? Paying a bank money.
Yeah.
You know what I mean? It's like, especially after 08, like, the big banks, they're controlling the world secretly behind the
right
everything. And, they're just taking our money and can you believe it? These jerks are going to front load the interest on us. It's like, that's not how it works. They don't like, I've uncovered that I think people actually look at amortization schedule and they think like, okay, so your $2,000 payment for 30 years should always be $1,000 principal and $1,000 interest. But the banks, they front loaded it, so they reworked the numbers so that it's like $1,900 interest on the front end, and and slowly flips over time. It's like no, like it's that at the beginning of the year, if your balance is $100,000 and your interest rate is 5%. You'd have to divide it all out by 12 to get your monthly balance. But theoretically, right?
Use 6%.
Well, yeah.
Then it'll be easier, right?
Yeah. 0.5% a month.
$500.
$500 a month. But my point is like, so over the course of a year though, like your interest, you're going to pay $6,000 in interest. It doesn't matter what your payment is. So if you pay more on the loan, your balance is just less. So if you get $50,000 and go put on your loan, the bank, because it was amortized, they're not going to change your payment. But now all of your payments would have a higher principal to interest ratio because on a 5% loan that was originally $100,000 and you just paid $50,000 down, right? It's going to be half of the 5%. It's still 5%, but it's 5% on 50,000. The remaining 50,000, so it's going to be 2,500%.
Your fixed payment's still the same, so more of the money is allocated towards.
Right, and now it would pay off a lot faster because a lot of your payment, your fixed payment, is more of it is principal, right?
Right.
It is simple that way.
Yeah.
So
it truly is, but there's a lot of those where I think there's people think that there's this secret out there that nobody knows about that can make something happen. And then those guys, they prey on it, right? And they sell them education or sell them, these packages that can give them this hack.
Well, it goes back to the emotion.
It costs them more.
It goes back to the emotion. Like, who do you want to defeat in life? It's like the IRS and big banks. You know what I mean? It's like, it's like the life insurance conversation when people talk about bank on yourself, be your own banker. Get this life insurance policy to be your own bank. It's like, that's not setting up your own bank. You have.
Is that the infinite banking?
Yeah. You have it. It's like you have an asset at the life insurance company. Like, newsflash, they're your bank, right? So you cut the bank out of the picture, but big banks are so bad, but you love insurance companies or something. I don't, it's like, it just doesn't make sense to me when really at the end of the day, what they're really saying is, have an asset and leverage your asset. That's all. The infinite banking, that's all it is understanding how to leverage your assets correctly and in some kind of prudent way.
Yeah.
That's it. It's not that complex.
I think what they'll do is they'll compare some of those processes or those programs to doing nothing, and everything's better than doing nothing, right?
Yeah.
It's like everything. So mostly anyways. And so, but when you really compare the different options, and then, if you know a little bit about the options, and you can make a choice of what's best for you, rather than somebody saying, hey, I've got this hack. You don't have to make any more income, but you can suddenly pay your house off in 5 years.
You know what the hack is? This is the hack. This is the true wealth hack. Okay. Make a plan and stick to it for a very long time.
That is it.
That's it. There you go.
It. Right there.
That's like, you don't even have to always do the right things, but if you do mostly right things, but you just do it consistently for a long enough amount of time, you will increase your chances of success at becoming wealthy exponentially.
That's the secret to everything, man. It's focusing on the input.
Well, and that's what the next thing I was going to say is if you want to speed up the time frame on that, you put more into it. You don't change the plan, right? It's like you don't go to look to make the fancier investment or the crazier thing. Just ramp up your input. Instead of saying 500 a month, put away 1,000 a month, right? Ramp up your income, put away more, and stay consistent on everything else you're doing. The thing that really, gets people is when they just hit that fear stride, and make a drastic change, or they look at it and say, oh, that's going to take too long. I want to speed up this clock, but I don't want to put any more effort in. Well, there's only two things you can change. It's your capital input or the amount of risk you're taking.
Right. I think everything comes down to, from investing, is consistency. That's really what it comes down to. It's like an analogy I give to a lot of people that I'm mentoring is let's say you want to get in shape. Mm-hmm. What do you do, right? It's about consistently going to the gym, not one day a week and you're just hitting it hard and you're doing everything that you can that one day and then the other days don't matter. It's better to go more frequently and you don't have to hit it as hard. Yeah. If you do that over the course of time, you're going to get in better shape, right? You're going to look better. The same thing with if you're eating. It's not about hey, I'm going to eat really well this one meal out of the week. And I think a lot of people look at investing that way, because to what you said, it's about consistently putting things away over time. You don't have to get everything right. You don't have to be perfect at it. You don't have to be the best, but you got to be consistent. The more consistent that you can be at it, the more that you're going to have. That's what it comes down to. And that's not waiting until that right time when you have a raise or you have additional money. It's doing it before you feel like you're ready. Yeah. Because if you wait until you're ready, time goes by, years go by, and they go by really fast. And then you're like, oh yeah, I was going to start that and I never did.
Time is your most valuable resource.
Yeah. You got to start before you feel like you're ready. It's got to be, when you're starting, it's got to feel like it's a pinch. Oh, I just put all this, I put money I put money away into the investment account and now I'm a little tight. It's got to feel that way. You're not putting excess money in there. That's where it's paying yourself first, right? You're putting it in there and you're trying to figure out a way, how do I live on what's left? And if I got a little tight, great. But if you do that for a while, you're not stressed about money anymore.
Yeah.
It changes. If you don't do that, you're stressed about money the entire life. Right?
Well, that's what they say, like pick your hard,
Yeah. It's not easy. It's
be-
hard.
yeah.
Either way you look at it.
It can be hard, for a shorter amount of time, or it can be hard, a little bit less hard, but hard forever.
Yeah. Yeah. And that's absolutely true.
And
You're going to sacrifice now, you're going to sacrifice later. You can't get out of it.
And I have helped people with their retirement plans that have learned this the hard way, and they still work in their 70s and 80s. And it's emotionally hard to see sometimes, actually, and help them through it, because that like they don't have the resources. And I'm not talking about like the person that has $1 million and is just scared they're going to run out of money. I'm like, because I mean, I've helped a lot of people across the spectrum, and it's tough when somebody just doesn't have the resources at the end of their life.
Have you ever had anybody that says, man, I wish I wouldn't have put so much money away?
Yes.
Yes?
It was typically around very speculative investments that they should have never made.
Oh, okay. Yeah.
So,
But I think most people have a regret of not putting it away.
Yeah. Oh, yeah.
Because time comes by and now we're sitting here and we're 60, 70, 80 and we don't have anything and we're trying to live on Social Security. Right? It's there. So they have the regrets of, I shouldn't have bought that extra car. I shouldn't have gone, on whatever. I shouldn't have spent that extra money on it. I should have spent, because it doesn't take long. If you sacrifice for a little bit, it doesn't take long, I don't think.
I think the biggest thing that prevents people is the underwhelming nature of the investment return relative to their current income when they're first starting. And so what I mean by that,
Okay.
so I have I talked to somebody that had an account that was started at roughly $10,000. To some people, that's a lot of money. Realistically, that's table stakes. Getting started, had a 20% return this first year. By all accounts, it's a phenomenal return.
Yeah, it's good.
People should be like, listen, if you do an investment in 1 year, completely passive, you haven't even had to think about it, you make 20%. That's not a bad situation at all, right?
Right.
You're doing just fine. And his question to me is, what else should I be doing? What should we be investing somewhere else? It's like, dude, you had $10,000. You just turned it into $12,000 by not looking at it for a year. What you need to do more of is get more money in that account, right? You need that your problem is that input. You got to stay consistent on the input, because 10,000 to 12,000 is not that exciting to somebody that's making 150 grand a year, right? It's just
right.
It's $2,000. It's like, but 30 years from now, the same guy that's making 150 grand a year and $1 million goes to 1.2 million, make 200 grand.
It makes a difference.
Man, that's more than I make in a year. I didn't even have to do anything, right? It's like, so when people actually, I think what holds people back is when they're making fairly decent money in the beginning. And then what they think when they think about return being good, they think it's kind of insignificant. So then they don't do anything because they're looking for, well, I'm making 100 grand a year, so I need an investment that's going to somehow make me 50 or 100 grand for it to be exciting, because I want it to change my life immediately. So I'm going to take 5 grand and I'm only going to look at investments that I can 10x in the next 6 weeks.
Yeah. Good luck.
And then they inevitably almost lose their 5 grand. And then they're like, well, investing sucks. I'll just,
right.
I'll just keep going out to nice dinners and on vacations and not adjust my lifestyle and make sure that I'm taking my financial future serious.
I had a game that I played with a guy that's managed my money for many years. And I said, my job is to increase the value of the account by deposits. Yours is to invest it and grow it. And let's see who can win. Okay. So the first 5 years, guess who won?
You did.
Me. It wasn't even close.
Yeah.
Right. But it got to a certain point where it is now, dude, I can't touch it. I could say where I just spend zero and I put everything in there. I can't. Now he wins every month. Every year. We stopped having the game. But I had to gamify it a little bit to make it fun, because for the beginning, you're not getting a huge return.
Well,
right?
you are.
It's
just
percentage wise, yes, but dollar amount, right?
Yeah.
You're not getting a huge one. So I think when I first started with him, I gave him like 25,000. I was so scared to give anybody money, because I think it was just after the Bernie Madoff thing. And I was like, I don't know if he just is going to take this and go buy a yacht.
Hey, for anyone listening, the easiest way to make sure you're not having a Ponzi scheme is if you have a third-party custodian. Remember that, third-party custodian. So the most common ones out there: Fidelity, Charles Schwab, Altruist is kind of on the rise. Axos, Goldman Sachs now has a custodian platform that they're using with independent advisors. You got like Morgan Stanley. Anyways, you're looking for somebody that is not your advisor to be holding your money. So if your advisor is, Bernie Madoff Investments and Co., and you log into Bernie Madoff Investments and Co., and that's the only place you can see your money, have some concern. You're looking for a third party independent custodian.
That is great advice.
That's what I tell people. I'm like,
I didn't know that.
I will actually bring that up sometimes. Like if people are like, it's the first time they've worked with an advisor, and I say like, aren't you curious how to know I'm not Bernie Madoff? And they're like, well, we didn't want to ask. Dude,
it's in the back of everybody's mind. I mean, if they're younger, maybe not. They might not know. But
I go
for sure.
Listen, because I'll never hold your money. I never take custody of it. I can direct how it's invested. I can facilitate service requests like getting your money sent back to your checking account. But you log into I custody at Charles Schwab, so you can log into Charles Schwab, which I don't control, right?
Yeah,
and see your account. You can see all the trades we've made. You can have all your accounting. You get your tax forms from them. You get your statements from them. If you can't get a hold of me and you really need something, you can call them up, and there's a whole customer service center that could take care of it. They might charge you a fee to assist you, but like the whole idea is I never hold your money. I never take a check into my hands. I never, right? Third party independent custody.
No, that's great. And I'm sure that's helpful because even if, and you're right, even if they don't ask it, they're thinking it. Because dude, I was thinking that for sure. And this person was recommended to me by, I went to a friend of mine that had money, and I was like, who's managing your money? That was how I found him. And It's been great, for sure. But I was terrified because you think, I was young, and that first 25,000, I'm like, I'm terrified. That was a big amount of money to me then.
Yeah.
And then so I had a little bit more. But I was still coming back from losing everything. And so I think I maybe had about 75 total, or if that, and I'm like, I can't give it all to you. I got to give let me give you a little chunk here. And then let me see if if I don't die, I'll give you another chunk. Right.
Yeah.
That's just how it felt.
That's not uncommon for people to feel that way, by the way.
That makes sense. Because you hear about those things and you just don't know.
It's emotionally a very big step.
Yeah.
There's probably few people in my client's life that they trust more than me. Like they have to.
You're the therapist on the down days, man.
I'm
right.
Yeah. I mean, luckily I don't have to do a whole lot of that, but I manage with what's called discretion, right? All the assets I manage are discretionary. So I can trade on somebody's behalf. I don't have to call them up and say, hey, we're going to buy more of this or sell this or whatever. We just do it. So they're trusting me to actually work in their best interest seriously every single day, pay attention every single, all the time. And they are trusting me that I'm looking out for their best interests. And we're oftentimes dealing with like their biggest, most important assets. Right. And I'm giving them advice that affects their entire life. At the end of the day, your wealth affects everything. Right.
For sure.
And so like, it's a huge position of trust. And I don't blame people for being a little like, I have 75,000. We'll start with 25.
Oh yeah.
And like, and what I found is they just want to see that like, I'm not buying options on Tesla stock or something and, we're going to lose it all. It's like,
they just want to see you don't you take and buy a car. That's what I was thinking,
like,
right?
Yeah. Well, you were thinking it was legit Ponzi. I tell people,
what if this statement's really not real and it's just not there? And he's just taking 50 cents to create this statement and mail it to me.
Oh my gosh. It's really sad. The Bernie Madoff thing was really, really sad.
Yeah, for sure.
So, as easy as it is nowadays to find investment advisors that are independent and have third party custody options, there is not a shortage of people though that are peddling private investments, that there is no transparency in that. There's no third party custody, right? Like if you do like if somebody is raising funds to do like an apartment syndication or something,
right?
You're going to sign all these docs and you're going to wire the money to a bank account somewhere. You know what I mean? That is the stuff where today you still have to be really careful and do some really deep due diligence to understand that this apartment building actually exists and there's an actual contract and there's an actual, fund set up
Right.
And, the Reg D filings are actually happening.
I do a lot of real estate investing where I provide capital for the fix and flippers that we talk about.
The day traders of real estate.
The day traders of real estate.
I think that's kind of funny, huh? But when you think about it, though,
I like that. I'm going to ask them then. See what do you think about this?
Hey,
Day trade of real estate.
Look,
there's a little more. There's a little more to it that they. If you know what you're doing, you know a little bit more about what you're getting into, right, and what it's going to be worth. But there could be some adjustments in the market.
But if you're day trading, is that not the same? If you know what you're doing, you can still be successful. You can still manage risk. You can still trade.
The difference with day trading is the stock values can be based on like a news story that comes out. There can be a news story that comes out that day and everything just crashes. And then tomorrow, another news story can come out and go, oh, we had this wrong. Sorry. And then it goes back. Like you're not going to have that with that particular house. It doesn't move that much. It can move a bit from if you're buying something now and you're planning on selling it in 6 months.
Yeah, but what about the time
it can move?
Yeah, but what about the time you buy the house and you close on it because it's it's a sweet deal. The only way you're going to get it, at this discounted rate, so that you have margin in it to fix and flip.
Yeah,
and you buy it and then you start doing the demo on it and you find out it was a meth lab.
Yeah,
unforeseen.
Most experienced
risk.
Yeah, for sure. Most experienced flippers, like the meth lab thing doesn't scare them. It's relatively easy for them to fix. But it's your newer ones, the ones that are like they just did their first few. There's a lot of those things that they'll overlook.
But that's the exact same in day traders, though. An experienced trader is going to manage the risk. Experienced traders typically are going to trade something like options. They're putting on spreads. There is some kind of risk management that they're employing. So I still think it's the same. I still think it's basically the same. It's like you're hoping that you can get in a trade and out of a trade in a favorable way in a short amount of time.
Gotcha. Okay.
Now, because of the illiquid nature of real estate, that time frame is weeks or months instead of minutes or days. But it's still like
you have a point. I see what you're saying. Yeah,
it's the same kind of thing. It's like, look, I'm not saying they're wrong for doing it. I'm not saying people shouldn't day trade. Right? Like I know people that day trade. I know people that have day traded for years. They've done it successfully. It would be incredibly stressful, I think, for a lot of people. Some people just love it, right? I also know people that have flipped homes and flip homes regularly and are successful at it. And I know people in both scenarios that have tried it and lost a ton of money. And I will tell you that I also have placed my own day trades. I don't day trade a lot, but every once in a while I see a setup that I think like, this looks like a really good setup, and I'll make a trade. And sometimes I lose some money. Sometimes I make some money, right? It's the nature of it.
Overall, are you up or down on day trading?
I've not, it's not been a significant amount of money that I've kept a P&L. So I can't answer that honestly.
Okay.
I cannot. If I am up, what I will say is for me, day trading is a hobby. Which I don't day trade often. But every once in a while I'll see a setup that makes I like that setup. And I have a smaller account set off to the side that I'll make, either day trades or swing trades in.
Okay.
It doesn't have performance reporting like that we use for this is just an account totally that I manage. So I haven't really kept a P&L on that.
Okay.
I don't know. I could be down over time. Okay. I really don't know. Now you have me curious. Like I'm going to go back and pull.
Yeah. So if you don't know off the top of your head, that means if you do have a gain, it's probably not much from a percentage basis, right?
And that's what I'm saying. It's like if I have a gain, it's not a life changing amount of money. If I'm down, it's also not a life changing amount of money. Again, that's just where I say it's kind of just like a fun thing, right?
Okay. Let me see if I put this in here.
I'm not somebody that generally thinks all of my serious money is
gambler.
That's probably the closest thing I do to gambling. I take my serious money is invested the same way that we invest clients' money, right? So just like with some of my clients, they'll have Robinhood accounts where if they want to go buy a stock or you know what I mean? They have you're better off if you have the itch, do it in an account with money that is a small amount of money that you definitely can lose, afford to lose, instead of call up and say, let's do something with my serious money. I think this is going to work out, right? So I do the same thing that I do for clients. And I think that's totally fine. I also am in the middle of a flip right now on a house. And it's queuing up to hit the market this week. And I think it's going to turn out just great.
Good. We were talking about that for a moment, and because we were talking about some of those investments that are, lose, right? So I was talking about how I'll do some, I'll provide some capital for fix and flippers.
Mm-hmm.
Okay. So what'll happen is, actually we just did one on Bluff Street, with some guys that have become really good friends of mine. But anyways, so, the first position lender will fund a certain amount, right?
Sure.
And then there's the down payment, and then I'll come and depending on the deal, I'll put the down payment. So this one was like 115,000 or whatever was the down payment. And so it worked out. We sold it last week, made money. It was really good. But there are some others that are in our real estate investing group that are seeing those types of returns, right? So I got 20% in 6 months, okay, which is a great return, right? And they're seeing those returns and they're like, oh, I want to get in on that. And so they'll do it and then they'll lose. And it's so hard to see, right? I've been in the lending world for 20 something years, 23 years now, right? And so I have a good idea of how to keep myself safe. And there's a lot of people that don't, right? And there's a big YouTuber that has a group that's a paid for group, and you go in there and then they promise all of these deals, right? And so a lot of people are looking at saying, hey, I'm going to put money in there and I'm just going to get these huge returns. And it's so sad that they'll call me and they're like, I lost 3 of them. They were all 80 grand. And I'm like, dang, that's a lot of money.
Yeah.
And they'll see the returns. And so it's like, it's hard if you go into some of those and you really don't fully understand it, how it works and how to protect yourself. And then you go through and you just put money in there. Right. And so that's one of those, like I have a rule, like if I don't 100% understand, if I don't fully understand how this thing works, I'm out.
Yeah.
And I have people that bring me deals all the time, investments like, hey, I've got this and it's going to be a really cool return. And they start going through the complexities of it. And I'm like, I'm out.
Yeah.
If it's like so many pages that I've got to try to wrap my head around it and understand it, and there's this cool return and somebody's really jazzed about it, it's not for me. I don't want to go through something. I don't think anybody, if they're looking to do investments outside of like, kind of what they're doing with you or whatever, it's like, if you don't completely understand it, it's okay to walk away from a promised return. Because sometimes people think, well, I don't want to miss out on that 20 or 30% return. And they don't even think about the negative 100% that they'll get, right? Losing everything.
Yeah.
Right? Like doesn't even cross their mind that I could lose it. They're just thinking like, I've never made this type of return on this investment. And here we go. We've got a guy that knows what he's doing and he's promising this and he's, and then it goes to zero. So sad, man.
It's so sad. And what I found is oftentimes so many times the people that are looking for those deals, they aren't doing the basics first, right? So they don't have a solid financial plan and like, oh, this is just so much excess. I got 50 or 80 grand. I can afford to lose it. It's like all they got. And they'll say things like, well, I have to be involved with real estate because the stock market is a scam. It's like, dude, that deal that you're going to pick up for a 20% return had a way worse risk return profile than being in a broad market index fund or something. You know what I mean? Like
if you don't know what you're doing, for sure.
Yeah. And that's what I'm saying. Like so you're just like, whoa, you're saying that's rigged, but this is literally like one step or tier above a scam, and you're going to put all your eggs in one basket with that. It's a ton of idiosyncratic risk. Right. Private credit is a place to make some money, is a place to lose a lot of money.
Yeah, for sure.
I don't know. I could probably go for a long time on private investments, but probably shouldn't.
I love them, but that's just, I've been involved in a lot of different projects.
But you have to, but that goes back to, knowing what you're doing, right? Or like that, like do what you know, right? So real estate agents tend to buy rental properties. Like they know real estate. They know when something looks like a good deal. They kind of get the process. They understand the liquidity factor. If they need lending, they know how to talk to mortgage lenders, right? They know how to qualify. They know how to, that's the world in which they live. So it feels comfortable. The most important thing is that they understand it. And so they tend to not, go out and like be scared, like, oh, my real estate could crash like 08 at any moment, right? It's like, So they stay the course. Anything can, right?
Mm-hmm.
But they stay the course. And going back to the prior conversation that we had earlier, is the consistency over time on doing one thing is probably going to have the highest likelihood of leading to success, right?
For sure.
So when I talk to mortgage lenders and they say, yeah, dude, I've been lending and dealing with borrowing people money for, 20 years. The first 18, I was borrowing them, the bank's money, but I understood how to underwrite a deal. And then I could watch deals and see what type of people foreclose on mortgages, or it didn't work out, or ran into financial issues later. And I understand what to look for and the questions to ask and all this stuff. And now instead of lending the bank's money, I lend my money. Okay. Like, two things. A, you have learned the skill, right? You put the time investment in. Now the time investment happened to overlap with you learning your own, craft. That was your active income. Two, that still is never going to be passive income, right? That's not a passive investment. It's an active investment. So people should just always understand that if you're going to make an active investment, you should demand a higher return.
Sure.
Right? Like,
to be fair, it was about 20 minutes of work.
Yeah. Yeah. Well, in this case, but if you think about, you got to listen to the pitch, you got to do some due diligence, you got to wire the money, you got to track it, you got to reconcile, you got to file the taxes on it, you got to, you know what I mean? There's steps here, and it takes some time, but if you're going to make an active investment, you should demand a higher return, right? Because if you can make, like if somebody came to me and said, hey, would you lend me money to finish fixing up this house? I'll give you 5%, and you got to do this work, right? But I'm good for it. I'll pay it back, and the underwriting is flawless. They want to borrow 50 grand on a $3 million house, and I'm in first position. I'd still be like, no, because I can buy T-bills for the same time frame currently.
Sure.
And it does not have to do anything. It's passive.
And to be fair to that 5%, I would say no too.
Yeah. But that's my point. You have to demand a higher, right? It's like you have to look at your alternatives and say, well, okay, what are my alternatives to use this money, and what's my return, my risk return expectation on those options?
Right.
If you don't know how to do that, hire an advisor. I don't know what else to say. Or read a lot of books.
No, I think so. Or also you can get with somebody who is doing some of these things and learn from them. I find a lot of people, like a lot of things that I do now, I have some people that have just helped, and they were doing it, and I could watch them. It was the best.
I've learned a ton. I have clients that do private money lending. They lend out their own money to these type of things. And I've learned a ton from them, and they're my clients. They hire me to do something that's not that, obviously.
Sure.
Right? Like, that is their thing. They know how to do this. It's very active for them. Mm-hmm. But I'm also sitting in a seat where I've been able to learn from that and observe it, and I'm still no expert on it.
So are they using? This is a question about those clients, and you don't have to answer if you don't want. But are they having? They have the money that you're managing, right? Mm-hmm. And then they have separate money that they manage or do those deals with.
Yes.
Is that kind of what they're doing? Okay.
Yes.
So I do something a little bit different, and that is because I like to double up the investments. Right.
Do you use a securities-backed line of credit to?
Yes, I do.
Yeah. No. I have clients that do that,
and I love it. And so it's like I've got this, and it's with the financial advisor, and we've got everything's going well there. We're getting good returns. We got a bunch of different things going on there.
Are you doing infinite banking? I'm just kidding.
I'm not doing it with life insurance.
Yeah.
But then I'll take it, and I've got a line of credit through Goldman Sachs.
Yeah.
And borrow that, and I'll put it out there. I do some self-directed IRA stuff as well. So that's a little bit different. I have to pull it out of an investment and do it. Unless I don't know if there's some sort of line of credit backed by an IRA. If there is, let me know, because I'm going to do that. But I
think there's actually tax law preventing that.
What? Dang it. Because I like it. I like doubling up the money that's invested. But no, it's great. I click a button, money gets transferred over. It's quick. And then I fund it and then pay it back and keep the difference.
Yeah, there's a tax nightmare if you leverage up a self-directed IRA. IRAs in general can be pretty tricky with leverage. You have to be careful how you do it.
Yeah. So I do several deals with the self-directed IRA, and they've been great. But I also like the.
Don't get me started on self-directed IRAs.
Okay, how come?
Oh,
Is this a bad thing for you?
Well, it's an annoying thing for me.
Okay. I want to hear your opinion on it.
My opinion is that everyone wants to do them, and most people that want to do them aren't qualified, and the people that are qualified and it could work, it's then doesn't make sense because they usually don't want to deal with it. It's like a very niche.
Okay.
It's like a very niche, very, very niche down thing. But it goes back to just, it's another thing that people get sold. It's an easy thing to talk about and sells like, oh, the secret to all of this is you have to self-direct your IRA and then buy whatever I'm selling, you know? And it is just, I very rarely talk to people that are doing it in total accordance with the IRS guidelines and aren't just absolutely committing tax fraud with it.
Okay. Like
knowingly or unknowingly.
They're somehow using it, like they're have access to some of the money somehow or something like that.
Yeah. The biggest one is when they buy it. Yeah. So the biggest one that I find is when they buy, people want to buy rental properties in a self-directed IRA.
Okay.
And they'll like self-manage it. They'll be their own property manager.
Oh.
Can't do that. Or they'll say, oh, I use my self-directed IRA to build spec homes. Like, and then you were the general contractor, like, and they're like, yeah, I know how to do that. So like, I could build them so cheap. It's like, yeah, that's why the IRS has a rule against it. You can't do that.
That makes sense.
And you also can't hire your son to be the general contractor, and you can't hire your brother to be the painter. And, you know, you can't, if you have a rental property, you can't hire your cousin to be the handyman to fix it up between tenants. And, you know, it's like, there's all these contingency that like, you really have to keep it all at arm's length and really be careful. And then you can't, so that's problem number one is like most people aren't doing that.
That makes sense.
And so they feel comfortable or they think they're getting a great return, but it's because they're cutting corners and adding value that they're like not supposed to be adding. Right.
Is that where the $5,000 limit comes into place, or is this just a separate restriction?
No, this is a separate restriction.
Okay.
So you can't, it's called self-dealing with the self-directed IRA. You can't self-deal. Gotcha. And it's basically because of the, like you can't you're essentially putting more into your IRA than you would otherwise be allowed by putting sweat equity in.
That makes sense.
Right. That's kind of that's the spirit of it all. Right.
If the IRS is watching, I do not do that. I'm just doing capital loans.
which I found is probably this is probably the best way to go for most people in self-directed IRAs. The concern there is if you end up having to own the property, it becomes a very big deal. If you're not very well capitalized in a very big IRA,
that would be tricky.
It would be very tricky really quick.
Mm-hmm.
But that's somewhat avoidable, right? Like you can see it coming. You could maybe sell the debt to a willing buyer before you have to actually foreclose. You know what I mean? Like you could sell distressed debt. You'll probably take a loss, but
yeah. No, that is definitely a risk, and that's something that I work on with the advisors, making sure that we have enough available. So if something like that comes up, that's weird.
Yeah.
But that's good advice.
Going to my second issue with it, when people own real estate in it, is like the capital needed for possible capital expenditures, repairs, right? So you can't go get a mortgage. So now you're losing one of the best benefits of real estate, which is, prudent, high levels of leverage over time. And now if something happens, like say, a tenant tears a place up, you need new flooring or a new roof. It's like, you can't just say like, oh, I'll just bring the contractor in and cut them a check out of my checkbook and away they go, like, no, they have to get paid from the IRA, which means your IRA not only has to have the money to own a home, but now you have to have cash set aside to pay for capital expenditures. So now you have a cash drag on the portfolio that your portfolio can't be fully invested with a significant amount of, excess liquidity. It doesn't.
That's a good point.
It doesn't make enough sense. And then on top of all of that to boot, here's the third reason why I think it just doesn't make sense is you lose the tax benefits of owning real estate, which is like one of the only just tax advantaged assets to own like that most people can go buy. So you can't depreciate it in an IRA. It can't get a step up in basis, right? Like you can't, if you have to write a check to repair the floors, you can't deduct that against the income.
Yeah.
So you just lose all these tax advantages.
Yeah, I agree. It doesn't seem like it would make sense if you're going to hold some of it long term.
Yeah, it does. I would say like, man, maybe if you were going to do like self-directed and get into like a syndication or something, well-capitalized syndication on a commercial or industrial property or something. But even at that, you just look at that and say, okay, well, how far away is that from just owning a REIT anyways? That's publicly traded and you just don't have the same potential messes. To me, I feel like it's bad asset location, right? I'm not against real estate. Anyone that knows me knows I'm not against real estate investing.
No, that makes a lot of sense though.
But
yeah.
like your IRA is likely such a small portion of what your overall net worth should end up being. If you want to get into real estate investing, then like keep the IRA with the liquid assets, keep it simple. Don't give the IRS a reason to, take half your money on it, forcing a taxable distribution of your entire IRA at one time because you broke a little clerical rule.
Is that what happens?
Yeah, that's what happens. Yeah. If you violate, if you make an error with your self-directed IRA and you get audited on it, and the IRS has cause, which by the way, remember tax court, you're guilty until proven innocent. They force a taxable distribution of your IRA. So they more or less close down your IRA. And so whatever your asset value in the IRA becomes all taxable income in that year.
Yeah, that'd be huge.
Oh yeah. Can you imagine if it's $1 million and you're just like, oh, an extra $1 million of income this year. Hey, by the way, your tax bill for, $500,000 is due.
Right. No, that makes sense. So don't do it.
There is someone for everything and everything is for someone. I think for the vast majority of people, they should make sure they're well informed and well advised and well educated before they consider taking that kind of risk.
Yeah. No, that's really good advice. How is your flip going?
Paint was done over the weekend. We got cleaners in there right now, and it should hit the market hopefully in the next couple of days.
That's awesome. Did you have to put a lot of rehab into it?
It was like in the middle. It wasn't a ton of rehab, like nothing structural, but we did have to do all new floorings. We had to grind some flooring, re-level it out, paint the whole house, take care of a bunch of stuff that the HOA was, this one was kind of behind on maintenance. The HOA was upset about it. So just bring it up to speed on a lot of that kind of stuff.
Yeah. It's one that's in the area.
Yeah.
Okay.
Yes. So I don't want to talk too much about it.
That's okay. Yeah.
But it'll probably be sold by the time this airs.
Awesome.
But it's a nice house, nice location. Someone will really love it. It's really well designed for somebody that wants to own like a second home down here, in St. George, right by Snow Canyon.
That's awesome. Do you do many of them, or just like once in a while here and there if you come across the deal?
Once in a while. So going back to the conversation about like you have to understand your alternatives. I mean, we've been looking for 2-3 years for deals. We very rarely find one that we feel pencils that has enough alpha in it that we want to deal with it.
Gotcha.
Right.
This is with your partners that you do. Okay. So you're not like looking hard, but you'll keep your eye open. So if something comes up, it's got a good margin, it's a good thing, then
I would say so.
We'll do it.
We look.
Okay.
But we find that the best opportunities find us. Like the ones that we end up doing typically find us. People reach out.
They're just in a tough spot and they need somebody to help them through it. Type thing.
Just different circumstances.
Right.
But that's me personally. That's my own situation. Mm-hmm. Don't advise it for, anyone in particular. I don't think people should, look to get into it without getting some kind of knowledge and advice and baseline. So let me give you that disclosure. I'm not trying to sell that to anyone, and I'm not trying to, anyway, so that's just my own, a glimpse into Brandon's, personal life.
Awesome. No, and there's a lot there. And I think there's a lot of people, if they look to get into it, should be really cautious. Partner with somebody that knows what they're doing first if they're going to try it.
Yeah.
It's really easy to lose.
It's really easy to lose. And when you lose, you don't lose small. You you tend to lose big. So
For sure.
but that's why I tend personally to be like more of a long-term investor. I try to have that mindset. Like it just, the longer I just put out a newsletter this week, and the premise of the newsletter was the longer you extend your time horizon, the greater your chance of success of being a successful investor, right? It's just like, even if things go bad in the meantime, the longer your time horizon, the more likely you are to have a positive outcome.
That makes sense.
So nothing's guaranteed. There's no free lunches.
Did you start investing pretty young?
Not as young as I wish I would have.
Okay.
How about that? My parents really focused. What's interesting is my dad was raised on hard work on the farm, but then my grandpa really emphasized the investment side. And, like manage the account, investments, track it. And, lo and behold, my dad wound up a CPA. My childhood, I grew up ironically, like my parents built on the family farm. My parents focused on us with entrepreneurship primarily. So, when we had the investment conversations, a lot of times it was more about like the investment in yourself, looking for the opportunities to make money, provide for yourself that way, that self-reliance. And in hindsight, I think that's like, it's really interesting because you can do it either way. But what my dad instilled in me from a young age was I don't have to take, I don't have to go out and get the first job offer out there because I know I can figure out how to make it on my own, and, so investing is somewhat like, to me, is the easy part, especially nowadays. Like it's not that challenging. What's paid the most for me, right? Like if I look at my investments, the best investments I've made is in myself and then in my business. And that is, had a significant return.
When
right?
you say in yourself, how so? Like what investments have you done in yourself that have paid off?
I would say, education, and professional networking.
Okay.
So like I'm very involved in the National Association of Active Investment Managers. And that's an organization that has provided a ton of value to me, but it's because I made that investment. Like, I pay to go to their conferences every 6 months, right? I fly out and I go rub shoulders with these dudes that from the outside looking in would be like, that's your competitors, right? Or whatever. It's like, whatever. But I learned so much by taking, days out of my schedule to go and be with these guys and learn things and see things from different perspectives and learn new skills and learn about, different technology solutions that are out there that people might be using or whatever it might be. That's added a ton of value. Going to college, luckily that I didn't have to monetarily come out of pocket to pay for that. The GI bill, I used the GI Bill. So
Awesome.
I've had a huge ROI on that education. Being able to take my foundational financial planning concepts and understanding growing up around the business and then marry that with a formal education around finance has been really powerful. And then, I've spent, compared to what you do, not that much, but a meaningful amount of money and time in further education in the CMT program, which has been a huge lift. So I've passed the first 2 exams in the CMT program, and I said for I'm going to take my first pass at the level 3 exam in December.
Awesome.
Wish me luck on that. Feels like there's never enough time to study, but I've done that. I'm about to engage with a coach for the first time here soon. Working on that engagement. So it's just, like nothing major, but like, dude, you can buy a $10 book that enables you to have a thought or a way of seeing the world or thinking about something or realizing an opportunity that goes out and makes you $1,000. That's $10 and an hour or 2
For
well
sure.
spent. You know what I mean? It's like, that's where I find the best.
No, I agree. I think a lot of people will do things by trial and error,
Mm-hmm.
and it's a painfully slow process and also can end up being way more expensive. I would argue it is more expensive to do it that way. But if there's something that you want to do, there's somebody that already knows how to do it. They've already done it.
Yeah.
And you just got to pay them and they'll just show you, right? Now, maybe they're not good. Maybe they are. I've had some that have been really good. But I think, if I'm going to go try something and I'm going to go by trial and error, I think I run the risk of losing way more money than what I would have paid an expert to just show me how to do it.
Yeah.
And sometimes those experts are really expensive and it's hard. It's, you're like, I'm writing a big check for this person to show me some things about business or whatever, But I agree. I've found that's the best money that's spent, right? A friend of mine has a good, he kind of has a good way of looking at things. And he says, if you're making less than $300,000 a year, don't worry about investing yet. Like traditional investing. Keep investing in yourself to increase your skills until you get there. And it makes sense. It makes a lot of sense there. And then, I think that's partly of what I did.
I think for a lot of people, I can disagree with that, but I think it depends what your aspirations are.
Yeah. If you don't want to, but if you don't want to have a higher income, for sure.
I think there's a lot of people
skills and figuring out how to, it's just having a high income is just skills that are valuable in the marketplace and figuring out how to apply those skills.
I don't disagree with that. I also think that I am the wrong person if somebody wants to always drive at like, I just want to be the wealthiest person ever. And the reason why is because I'm more of like the work-life balance guy. Truthfully, that's like, if you talk to my partners, I'm at the office early. I work really hard. I study really hard. I work really hard to learn new things. But if I'm not at the office, I really try to not be at the office. So I don't really do nights and weekends. Very rarely will I do a meeting after 5. Don't really take calls or answer emails on the weekend. Like, it's my time. It's my time with my family.
Yeah.
And so the way that I operate my life is have enough to fund all my goals, have enough to, grow the way that I want to grow, but also live in the present. Like I enjoy spending time with my family and my kids. And my aspiration personally isn't to be a billionaire. And I am comfortable with that. Does that make sense?
Absolutely.
So, now I do just fine financially. But if I think about like, if I go into like my clients, into their mind and then into their lives and look, and I know people that have, worked, good jobs for a career, but they had those great experiences with their family. They're going to retire and be able to maintain a similar lifestyle and they're happy. I'm happy for those people. I think it would have been really poor advice if somebody said, to those people, like with that, their goal and aspiration being like, I want to live a normal life with low stress and, just retire at 60, 65 and spend time with grandkids or whatever. If somebody said, oh yeah, don't start your 401k till you make $200,000 a year or $300,000 a year or whatever. Does that no, I get
it. Some people, I think their goal is to have a simple life and there's others who want to change the world and we need them both.
There's nothing wrong with either. I'm just saying sometimes people think everyone has to be like the 75 hard guy. You know what I mean? Like you can always do better. You can always better yourself. You can always make more. You can always do, you know what I mean? Like, grind harder. It's like, I did that when I was younger and not to say I'm old, but I really just I didn't love it. You know what actually kind of ruined me in hindsight? I think about this, was when I was in the Army. I joined the Army and you would think like you probably work the hardest when you're in the Army physically. Yeah. But we would go on these training rotations and you would work like it was just work 24/7,
mm-hmm.
right? I mean, you would wake up in the middle of the night after guard shifts, but then you would get home and like a normal work day was like, you wake up in the morning, exercise with all your buddies, you have a nice hour-long lunch and, there's really nothing to do except sweep a parking lot or something. And then you go home at 3:00 and you're like, it's kind of nice. And then no one calls you on the nights and the weekends. And I realized like, wait, this is kind of nice. And so when I got out of the Army, I was like, I don't want to go back to work all the time, always answer my phone, always be, beholden to the clients, the customers, whoever. And so I just made a conscious decision that that's not how I'm going to run my life or business. I remember when I was actively selling real estate in 2020 and 2021. I can't remember what year it was, but I had a pretty prominent agent in town, and she said, well, you could just show the property tomorrow. And I was like, it's tomorrow's Saturday. She's like, well, aren't you going to show it? And I said, like, my clients, I'll just talk to you. We'll show it Monday. She's like, what? You don't? I'm like, I don't really do showings on weekends. I really try not to. She's like, well, it must be nice to run your business and be at a place in life where you can do that. And I'm like, and like, I know this agent probably made 2 or 3 times as much money as I did at the time. I'm like, it's a choice. It's a conscious choice of mine that I can say, like, I have enough, right? There's a chapter in the book, Psychology of Money by Morgan Housel. That's really awesome. And he just talks about the moving goalposts, right? And people get to be executives and do all this stuff like Bernie Madoff. We were talking about Bernie Madoff was a successful market maker and would have been wildly, very wealthy in his legitimate business. But he had that drive for just like Jordan. It was Belfort. Never enough. Yeah, it was never enough. And so these people then go, it's like, so I read that. My experience in the Army taught me how to live on not a lot of money. I will promise you that. I just said,
secret right there.
Well, I just said, like, look, I want to have enough. I want to be comfortable. But beyond that, like, I want to be cautious about how much I chase just to chase. So I think it can go both ways. I think people have to find out what do they want.
For sure.
Right. Dude, like, if you told me your goal is to be a billionaire, dude, like, I'm happy for you and I'm rooting for you. Right. And you keep turning money as fast as you do and stuff. You probably get there. It's just like, I don't know. It's like not for everyone though. Not for me.
Yeah, for sure.
But everyone has different goals.
Right.
And that's why everyone needs individualized advice around their own money.
Yeah.
And that advice needs to not just be, what did I do for success, but what do you need to do for success given your circumstances, your situation, and what you have available to you that would then be in alignment with achieving your goal.
Right. No, I think that's good, especially if, some people don't want to go for it, and that's fine. There's nothing wrong with it. I think for me, there's been stages. I think early on, getting out of the family being paycheck to paycheck, right? Mm-hmm. I had a page that my mom gave me that I wrote when I was 7 saying I was going to be a millionaire, right? And so I think that first stage was grinding until that happened.
Yeah.
And yeah, working 80 hours a week. I was doing whatever. I was trying to learn whatever I could. I was trying to partner with somebody on deals or whatever. Yeah. Just trying to make it happen, put money away. And then after that or so, it became freedom. Mm-hmm. And so I had a point in time, this was kind of before COVID, and we had, I was working 25 hours a week or so, and we were having huge profits monthly, right? And so like, it was great. But then, so that was like stage 2. And then the next stage was, freedom's cool, but what would be really cool is impact. I need to have some sort of impact on the world.
Yeah.
And that's more important to me. It's bigger than freedom. Right. And so that's kind of driven me to start doing things a little bit more, start working a little bit more, start doing some of these other things that kind of get out of my comfort zone, or even doing things like this. It's the impact.
Yeah.
There's a lot of people that I've learned from that I think, what if they didn't teach? What if they didn't share that with me? My life would be way different. And so I feel like for me personally, like I have, there's kind of this obligation to teach and share those things because of, all of it that was taught to me. Mm-hmm. And so I don't know. I think there's just there's different stages, and maybe you won't have that. Maybe you're like in the freedom stage and you're like, this is super cool and I'm just going to stay here. And that's awesome. Like there's nothing wrong with that. And then there's others who, impact, right?
Well, like, I think if you looked at my calendar and I could give you more context, I think we would see I'm probably in the similar stage, right, of impact.
Okay.
I mean, I spend probably, from a business perspective, an unreasonable amount of time giving people advice and trying to help people.
Yeah.
That is not profitable.
Yeah.
But I like the impact. Mm-hmm. it reminds me of a quote around money where people say money can't buy happiness. And I really need to look it up. It might have been Charlie Munger that said this, but if you think money can't buy happiness, it only means you haven't given enough of it away.
Yeah, that's huge.
There is something to be said about being, charitable and giving, whether it's giving of your money or giving of your time or your, whatever resources you have. That's the impact, right? So you're talking about sharing
there's so much,
your time and talents, right? Mm-hmm. Maybe you are, maybe you aren't. I don't know, cutting checks at the soup kitchen or Switch Point or whatever, but to give your time and talents is similar, right?
Yeah.
It's what can I do to give back? And
we do this thing every month. It's called the $100 Dinner Club.
Yeah.
And you might have seen a couple of videos about it, but what we do is we get a group of people together and we go to random places for either dinner or lunch or whatever. And everybody brings a $100 bill. And then at the end, I'll bring the server up and I'll just, thank them for serving us. And I hand them this envelope, right? The last one we did was $1,300. And it's so cool. And it's like when we collect, all of us are working, pulling some resources together. I mean, for all of us, $100 isn't much. But when we put that in there and we give this server $1,300, like it's impactful for them.
Yeah.
We go and we just have a good time. We're chatting with everybody. We're laughing. And then at the end, like we have this really cool experience where, we've had some people in tears. We've had some single moms that are like, you have no idea how much this makes a difference for me. And that's just something little. I hope more people do it. It's kind of cool. I create a video about it. And it's funny when I did the first video about it, I was kind of worried about the haters a little bit.
The haters, man. The haters will always come.
Because I remember years ago, I tipped somebody. We went into this sushi restaurant, and my kids were young, probably about your age, and they were just wild and crazy. Like I just felt like I wanted to choke them out. And this server came, and she was so amazing with them, patient with them, and just totally turned their energy around. And so I gave her $100 tip, and I posted about it. Like I was so appreciative of this server for making what was kind of a pain of a night into something that was really joyful. And so I posted about it, just celebrating the server. And I had a couple people just hate on it and just get really, really upset that I would, they were struggling in life and I can't believe you'd give somebody $100 and I can't even go to dinner. And so when it came to doing this $100 dinner club, I hesitated about posting because I'm not trying to do it for the views or whatever. Right? I hesitated about posting, but then I thought about it. I go, why am I doing this? Why am I doing the $100 dinner club? And it's because I saw somebody else do it on social media, and it was a friend of mine. And then I started seeing a couple of people doing it, and that's what inspired me to do it. So I thought, well, this is bigger than just the hate that I get. And so we started doing it and I started posting it. Now, every time we post a video about it, I'll get people who follow me that I don't know that are like, oh, this is such a cool idea. I'm setting one up next week and we're going to do it. And so it's like that impact is greater. It's not just the $100 that you give. It's that you give $100 and then you also inspire others to do something similar.
Yeah.
And the more that it can grow and the more people that do it, you've got all these servers all around the country that are getting it. And so then it's like, I'll deal with the haters. I don't care. If I can inspire some other people to do it, that makes more sense to me. Let's go.
Yeah. Well, I think as long as you're posting with your heart in the right place,
for sure,
that's what matters. Otherwise, like if you're charitably giving or you're doing something like that, and it's like working out when they say like if you don't post a selfie, did you really go to the gym? Like if you didn't tell everyone about it, did you really do something kind for someone or whatever? It's like it's one of the reasons I don't log into LinkedIn ever. It's like it's always everyone patting themselves on the back for doing something good or whatever. It's like it's the table stakes, man. Way to be a good human. But I think if you're caveat though, if you're trying to inspire other people to have a bigger mindset than just them and their immediate presence, then that's cool.
Right. See, and I kind of, I understand what you're saying. But I kind of see the other angle of it though, as well. Like if I log in and my feed is filled with nothing but positive stuff of cool things that people are doing, I love it. I like to see what they're doing. And then when I meet up with them, I like to chat with them about some of those things that they're doing. It lights me up. It lights them.
Yeah.
You know what I mean?
Yeah.
And I don't know if they're doing it for the views or not, but I think on sometimes it's inspiring. Like some people will post these videos where they've made this major transformation, right? They've lost all of this weight.
Yeah.
And I love those videos,
Yeah.
right? Like it's so cool to see them going through and they're putting in the work and they're doing all of this stuff and then they have this result.
Yeah.
And so if they posted it every day, like back at the gym, right? Eating this piece of chicken, back at the gym. Like I love that because they're putting in the work and they're doing it. And that inspires me. Like,
yeah,
I got to make sure I'm going to the gym every day too.
Well, it's the difference between inspirational and, bragging.
Sure.
Or gloating or whatever.
Some people may look at it and think they're bragging, and that's fine. I just don't view the world that way.
But it just goes into the intention of someone's heart, though.
Yeah.
Right.
Yeah.
More or less.
But you have to be able to celebrate your wins for sure. I remember when I there was a day, and I keep track of like the net worth. I've got this app where I keep track of everything. And I remember the one day when it said $1 million. And this was, I don't know, it was quite a while ago, but it said $1 million in there. And I was so excited about it, right? I wanted to share because I wanted celebration. I wanted to celebrate it, but you can't, right? Who can you share it with? Hey, guess what?
Your financial advisor.
So I sent it to my dad and I said, Dad, I did it. And I sent him a picture of it. And it was the coolest thing ever. So now when I talk to people about some of this stuff, I tell them, use me. Send it to me. I want to hear, if you just hit some milestone, you got 100 grand in the bank, you got 10 grand. I don't care. If it's a milestone and it's something that you want to celebrate, I want to celebrate with you. And I don't care if that's your first 1,000, your first 10,000, your first million. I don't care what it is. But I want you to be able to celebrate or have somebody at least celebrate this accomplishment that you did. Because sometimes it's not in your inner circle. I can't send it to all my cousins and be like, guess what, right?
Yeah.
They might, I've got cool cousins, but maybe some are going to be jealous. But I think people need somebody to help to celebrate them. So you're right. Probably the financial advisor. You're like, heck yeah, let's go. Let's party.
Yeah.
And I want to be part of that as well. And I'm like, if I'm getting text messages every day of these milestones, like, hey, I hit this one. Hey, I hit this one. Dude, that lights me up. Like, I'm excited to see that. And I'm hoping as I do some more of the channel and we talk about the financial stuff and all that, and maybe they'll do that and that'll just light me up. But I want to be that person that can celebrate them. I'm not judging. It's not negative to me. And you need somebody to help celebrate those wins that you have. And I get it. You can't always just put it out there, right? It's not well received, but it is from me because I love it.
Well, I one of the things I like about you the most is that we so often disagree on something from the angle that we're looking at it, but we also really agree on so many things at the same time.
Right.
It's a really interesting dynamic. It's always fun talking to you.
Which part of so you disagree with part of that? Like celebrating?
No, just like in general, like you're like the whole context of, is it gloating or is it celebrating? Is it showing your, sharing your wins to be inspirational, or is it just, bragging? Gotcha. And it's, we both see it a little bit different or think about it a little bit different. And it's fun to be with people that don't always just think the same exact way as you all the time. Okay. So I appreciate that about you, right? Because it gives me a different perspective, right? And I like learning and hearing other people's perspectives. Yeah. So
that's awesome.
We probably ought to give this a wrap.
Okay.
It's been like, I don't have my watch on today, but it's probably been like an hour and a half.
I turned mine
at
off.
least. So
it was fun, man. I figured we'd have a good time.
Yeah. Hey, YouTube channel. Where are you at? How do people find you?
Yeah. So it's, for YouTube or Instagram, it's at Christian Duncan. The YouTube channel is Christian Duncan Finance IQ.
Okay.
Yeah.
Easy enough.
Absolutely. We had a good time.
Cool. Well, I look forward to it. And next time you find the next big financial scandal or scam, we'll have to have you back on and we'll chat about it.
Let's do it for sure. We'll do a video together and then we'll get a bunch of haters and it'll be awesome.
Yeah, bring out the haters. Okay. Hey, appreciate you coming in.